Every modern central banker repeats the same line. Gold is old. Gold is symbolic. Gold is a relic from a simpler time. They talk about sophisticated derivative markets, forward guidance, quantitative easing, swap lines, and balance sheet expansions. They say the real action is in interest rates, in liquidity operations, in carefully worded press conferences. The message is clear. The future belongs to digital entries and clever models, not to metal pulled out of the ground. And yet, quietly, almost none of them ever sell all their gold. Behind the scenes, in late-night calls between Zurich, London, New York, Frankfurt, and Basel, something very different happens. Gold is lent, borrowed, swapped, and pledged as collateral without ever appearing on a public ticker. Official reports call these technical operations, or balance sheet management. Bullion banks call it collateral optimization. The language is cold and sterile, but the effect is simple. Gold still moves at night. And when those movements are followed long enough, an uncomfortable pattern appears. The same system that insists gold no longer matters still treats it as the one asset that never blinks. This is the gold dossier, where money, power, and history collide, and nothing is ever as simple as it looks. Gold is not just a shiny lump in a vault. It is the emergency brake on the global financial machine. It is the collateral of last resort when trust runs thin. And central bank swaps are the hidden tracks that allow that collateral to move around the system without anyone admitting it is moving. Officially, the world lives in a pure fiat era. Currencies are backed by the full faith and credit of governments. The textbooks say the gold standard is over, buried in the 1970s. Unofficially, the old standard never died. It simply stepped out of the spotlight and into the plumbing. To see how the story reached this point, it helps to go back to the last time gold stood at the center of the stage, not in the shadows. For most of modern history, gold didn't just influence the system, it was the system. In the 19th and early 20th centuries, major currencies were IOUs for specific amounts of gold. Central banks and treasuries held bars in their vaults, and citizens, at least in theory, could redeem paper for metal. Confidence in the paper rested on one simple belief. The metal was actually there, and it stayed there. The logic seemed straightforward. Gold in, paper out. Gold out, paper in. If more paper was printed than gold could back, confidence would break and the system would correct. Then came 2 world wars, massive reconstruction, and the most ambitious financial treaty in history, Bretton Woods. Under this arrangement, the US dollar became the central anchor. Other currencies pegged to the dollar pegged to gold at a fixed price. On paper, it looked clean and rational. In reality, the system carried a hidden fracture. Governments loved to spend more than they collected. Wars, welfare states, reconstruction, Cold War competition, each new effort demanded more money. The supply of gold did not grow fast enough to match the promises written on paper. Foreign central banks understood this long before the public did. They had the right to redeem dollars for gold at the official price, and they quietly began doing exactly that. Dollars went out, bars came in. The gold flowed away from the anchor, even as the world pretended it was unshakable. By the early 1960s, something had to give. The official price of gold no longer matched reality. Governments had 2 choices: admit the truth by letting gold reprice higher and expose the inflation of their promises, or try to manage the gold market itself to preserve the illusion. They chose management. The London Gold Pool was born, a secret cooperation between the United States and several European allies designed to keep gold under control. The plan was simple: pool a portion of national gold reserves and intervene quietly whenever the market price threatened to rise above the official level. If the price climbed, gold would be dumped into the London market to push it back down. If the price fell, some would be bought back. To the outside world, the gold price looked fixed, stable, almost boring. Behind the curtain, central banks were scrambling to keep it that way, bleeding reserves to defend a number that no longer matched the real world. Every bar that left a vault to defend the official price was more than just metal. It was a vote of no confidence in the story politicians were telling. The market was demanding less paper and more metal. Governments needed the opposite. Eventually, the arithmetic broke. The pool lost too much gold. The United States ran persistent deficits. Foreign central banks continued redeeming dollars. The illusion of infinite paper backed by finite metal could not be sustained indefinitely. In 1971, the United States shut the gold window and ended dollar convertibility. The link between the world's reserve currency and gold was cut. Official statements declared gold demonetized, reduced to just another commodity. The age of pure fiat had arrived, or so the narrative claimed. In reality, governments did not suddenly lose their need for an anchor of trust. They simply lost the ability or the willingness to let the public see it directly. Gold moved from the front of the stage to the backstage corridors. Central banks still held thousands of tons. The bars did not disappear. Their role changed. Instead of backing the currency directly for the average person, they now backed the system indirectly for other institutions. At the same time, a new architecture grew around the dollar. Offshore eurodollar markets, global bond markets, complex derivatives, and a sprawling shadow banking system. Credit and liquidity began to move around the planet at high speed, not based on metal, but on confidence. Confidence in dollars and central banks, and in the assumption that liquidity would always be there when needed. But this new structure had a weakness. When trust wobbles, everyone reaches for the same two things: cash and collateral. Not just any collateral, but something that doesn't rely on someone else's promise to pay. Something that remains what it is, even when banks fail and governments wobble. Something that is nobody's liability. There are very few assets like that. Gold is one of them. So in the shadow of the dollar system, a quiet second layer grew. A layer in which central banks could lend gold to big banks in exchange for cash swap gold for foreign currency and then swap back later, and pledge gold as collateral for short-term funding without ever admitting that anything had really changed. On balance sheets, these operations are wrapped in careful language. Gold on hand, gold on loan, gold receivable. Sometimes they are merged into a single line, gold and gold receivables, so that physical bars and IOUs are blended into one neat figure. The public sees a reassuring number. The system uses the same metal again and again. Underneath that language sits a simple idea. Gold reserves should pull double duty. They should be seen as untouched, but used when necessary. They should be counted as permanent, yet mobilized as temporary collateral. That is where central bank gold swaps live. The term sounds technical and obscure, but the mechanics are not complicated. A swap is simply a loan with collateral, wrapped in central bank vocabulary. Imagine a central bank holding gold bars in a vault, marked on its balance sheet as reserves. A bullion bank, or another central bank, needs either gold or cash. They strike a deal. The central bank temporarily transfers ownership or claim on some of its gold to the counterparty, and in return, it receives cash or foreign currency. The key condition is that both sides agree to reverse the transaction later at a set price or rate. On paper, this is described as a swap rather than a sale. That wording matters. A sale would mean the gold is gone, reserves are reduced, and politicians would have to explain what happened. A swap allows the central bank to say, with a straight face, that it still owns the gold, even if someone else is using it for now. Sometimes the bars never move physically. They remain in the same underground vault at the Bank of England, the New York Fed, or another major custodian. Only the legal claim on those bars changes hands. A ledger entry, not a forklift, does the heavy lifting. From the other side, a bullion bank may take that swapped gold and sell it into the market, using the cash for other trades, then buying the metal back later to return it. Or another central bank might use the temporary access to gold as collateral to secure crucial funding from private markets when conditions are tight. In either case, gold becomes the backstage pass that grants entry to liquidity when the doors are otherwise closed. On a spreadsheet, this activity looks clinical. Notations, codes, maturity dates, interest rates. In reality, it is the quiet admission that when stress rises, financial actors still reach for something that is real enough to be trusted without explanation. Behind many of these arrangements stands an institution that likes to describe itself as the bank for central banks. In practice, this bank functions as the system's shadow broker. Central banks that do not want to leave fingerprints on each other, S-books can use it as an intermediary. Gold swaps, gold deposits, location swaps, where claims on bars and specific vaults are exchanged, all can be organized through this middle layer. Often, these operations are settled after public markets close. Quarter-end approaches, balance sheets are tidied, exposures are shuffled, and what began as a messy reality becomes a neat table again. The metal may have changed hands, then changed back. The loans may have been rolled over. The public sees only the endpoint, a line in a report months later. The result is a strange dual picture. Officially, central banks present themselves as living in a post-gold world, guided by models, forecasts, and policy frameworks. Unofficially, they continue to treat gold as a crucial piece of emergency infrastructure, the one asset that still works when confidence gets sick. This behavior mirrors a better-known tool, dollar swap lines. When crises hit, whether during the global financial crisis or the pandemic, major central banks set up swap lines with the U.S. Federal Reserve. Those lines allow foreign central banks to temporarily receive dollars in exchange for their own currency, then swap back later. It is a way to export dollar liquidity to the world when everyone suddenly wants the same thing. Dollar swaps are openly acknowledged. Press releases are issued. Charts are published. They signal that central banks will stand behind each other's paper when markets are stressed. Gold swaps send a quieter message. If dollar swaps say there is trust in each other's currencies, gold swaps whisper, just in case, there is still trust in this metal. Both belong to the same safety net. One layer is public, glowing in press conferences. The other moves in dim corridors, recorded in language that most people never notice. If gold were truly obsolete, none of this would exist. There would be no reason to carefully engineer structures that keep it formally on the books while using it as collateral off the books. There would be no incentive to merge physical holdings and receivables into a single line. There would be no need for complex agreements that treat it as something more than a commodity. You do not build an underground railway for an asset you do not care about. So why keep these movements quiet? Why not simply admit that gold still plays a role? Part of the answer is optics. Imagine the headlines if a major central bank openly declared that it had lent out a large chunk of its gold to support stressed banks or funding markets. Confidence is a fragile thing. People take comfort from the idea of reserves that are untouched, solid, and permanent. The more those reserves are revealed as active players in a dangerous game, the harder that comfort is to maintain. Another part is political convenience. As long as gold remains on the balance sheet, counted at some official value, leaders can point to it as proof of strength. A country with large gold reserves appears more secure, more serious, more anchored. If those same bars are quietly doing double duty as collateral, helping to rescue markets or support fragile institutions, the complexity does not appear in a campaign speech. And there is a deeper reason. The less the public understands about how gold moves, the easier it becomes to maintain the narrative that fiat money is natural and permanent. Gold is turned into a kind of financial ghost, dismissed in public, summoned in private, never fully acknowledged, never fully discarded. Yet the ritual continues. Gold moves quietly between central banks. It moves between central banks and bullion banks. It shifts as claims on specific vaults, as lines and agreements written in careful legal language. It steps in when other collateral is no longer enough, when markets start asking hard questions that politicians would rather not answer. Time after time, when something breaks somewhere in the system, gold is mobilized in some form. Sometimes this is visible as net purchases by certain countries. Sometimes it is hidden inside obscure balance sheet lines. But the direction is remarkably consistent. Over years and decades, official sector gold does not vanish. In many cases, it accumulates. Daily life still runs on fiat. Salaries are paid in fiat. Mortgages are denominated in fiat. Groceries, rent, subscriptions, all denominated in units that depend on confidence, law, and custom rather than metal. For ordinary people, gold plays no visible role at all. Yet the behavior of those who manage the system tells a different story. They hold on to gold decade after decade. Some states increase their reserves. Others repatriate bars from foreign vaults back to domestic soil. Quietly, legal frameworks are updated to clarify who controls what in an emergency. Central bank swaps and leases add another layer to this story. They show that gold is not simply sitting in darkness waiting for a symbolic end-of-the-world moment. It is actively integrated into the day-to-day flexibility of the system. When dollars are tight, when trust thins, when collateral is scarce, the metal still answers the call. The message is simple. The fairy tale about the barbarous relic is for public speeches. The shadow standard is for insiders. Now, this does not mean that anyone should rush to worship gold as a magical answer. It does not guarantee safety. It does not solve all problems. Gold has its own risks, its own volatility, its own cycles of fashion and neglect. But one reality stands out. The people designing the game keep one asset aside as collateral of last resort. Paper is for normal times. Gold is for when normal stops working. The next time a crisis hits and officials line up to declare that everything is under control, it may be worth asking a quiet question. While cameras are pointing at the press conferences and the carefully crafted statements, what is happening behind the scenes? Which lines on which balance sheets are being quietly adjusted? Which bars and which vaults are being pledged, swapped, or leveraged, even as the public is told they remain untouched? History has answered that question many times. Empires rise, declare their paper unshakable, and eventually lean on metal when that paper is doubted. Modern states scoff at gold in textbooks and then turn to it in turmoil. The slogans change. The collateral does not. Gold still moves at night, not for nostalgia, not for romance, but because in a world built on promises, there is still power in something that never had to promise anything at all.